Hi, Jim Kruzan, and welcome to our capital market review for the second quarter of 2024. Just want to get this disclosure page out. And as we do every quarter, we come up with a theme that encapsulates kind of where we are or how we feel about where we are at this time. And I'd have to go back to the 1970 Crosby, Stills, Nash & Young album, Deja Vu. The reason is this seems very similar to our comments from just 30, 60, 90 days ago. Comments really haven't changed much because a lot of the big macro data hasn't changed either. And not from that album, but from another Crosby, Stills, and Nash album from just before the 1970 album hit Deja Vu. David Crosby penned Long Time Gone. And one of those lyrics was, "It's been a long time coming." And this recession that's been long awaited and all the data that continues to turn negative, while still no recession, it certainly feels a lot like it's been a long time coming. So why do we do this? We do this because we want to know where we are in terms of the economic cycle, and more importantly, where we're heading. It's especially important for those who are retired because taking a large drop in portfolio value, either heading into retirement or during retirement, becomes problematic. So if we see things that look troublesome and can take defensive action, generally over a business cycle, it makes good sense to do so. So we want to see where we are and what the Fed's up to. And the Fed has been really quite constrictive. And now they're talking about lowering rates. The question really then becomes, why? Is it job well done and they beat inflation? Or is it because they also see some of this macro data that's suggesting the economy rolling over? Either way, we're maintaining a defensive posture and we will be data specific. So depending on what happens, things get better, things broaden out, we'll certainly participate. We've said for quite some time, there's three things that could happen. One is we get a recession, in which case the data continues to show weakness until we see a drop. And that's generally how it works. Recessions don't occur as if we're landing an airplane on a runway, nice and smooth and gentle. Things decay, markets ignore, and then the bottom drops out, and then everybody heads for the exits. You see a 30, 40% drop in the matter of a month or two is typically how these things play out. We could get the soft landing. They don't happen often, low probability. But if we do see that, then we should see data improve. We should see the unemployment numbers improve. We should see credit delinquencies improve. We should see the leading economic index also improving. That's currently not the case. The other thing that could happen is the markets could broaden out. We're looking at that. That has not been the case, as you'll see in a moment, through the second quarter. One could argue the last 2 weeks or so into this new third quarter, we're beginning to see some signs of that. It has been a very narrow market, which in and of itself isn't certainly a sign of a healthy market. The question then becomes, if we get this broadening out, what does it telegraph? Is it better times ahead and potentially this soft landing? Or is it more brought about because of FOMO? Valuations are getting high in that magnificent seven space. Money goes somewhere. We see this rotation out of big tech into other areas. We want to take that into consideration as well. As far as economic data is concerned, the leading economic index continues to weaken. It weakened last month again, 0.5%. The new data, I believe, comes out the end of this week. The unemployment rate has also risen. It's now just a hair over 4.1%, and it was 3.5% within the last 12 months. It's not so much the fact that it's still relatively low, but it's the rate of change off of a low base that has the Fed somewhat concerned, and also one of the reasons that they're interested in cutting rates. Credit card delinquencies, loan delinquencies, car loan delinquencies are on the rise. This also will be updated in the next several days. This data is through May, does not reflect the June data. And delinquencies, those that are over 90 days late, are almost now 11%. Just a year ago, it was just above 8. That's almost a 30% change in delinquency over a year. That's a very big change over a relatively short period of time. The reason I said deja vu is we're seeing more of the same, at least in the second quarter and for the first half of the year. The S&P was up 4% for the quarter, up over 15 for the first half. NASDAQ up 7, almost 8 for the quarter, up over 19 for the half. But over that quarter, the Dow Jones actually fell. The Russell 2000 small cap actually fell. The aggregate bond index actually fell, as did the 20-year Treasury. Interest rates actually went up and bond prices went down. And we saw that and saw the effects of that for the first half. So you've got the Russell 2000 through June 30th, smaller companies, much more economically sensitive, were barely up 1.7% for the first half compared to the S&P up over 15. Huge spread. That's beginning to broaden out a bit since June 30th, but it's still a huge delta between those two. And why is that? Well, the answer last time we spoke was the Magnificent Seven. And the answer this time is still the Magnificent Seven. So here for the second quarter and for the first half of the year are the returns of those Magnificent Seven: Microsoft, Apple, Google, Amazon, NVIDIA, Meta, and Tesla. And you'll see the returns in the second quarter quite robust, and also the returns for the first half of the year. NVIDIA was up over 149% for the first half. Below that, you'll see the weighted return that is taking each individual stock's performance times the percent allocation of that stock to the S&P. In the case of the second quarter, those 7 contributed 5.98% to the S&P 500 return. The S&P was only up 5.13, which would suggest that the other 493 stocks didn't do so well. And remember, just the slide before, Dow was down, Russell was down during that same period. And for the second half, the first half, we saw essentially the same thing. The weighted contribution of those 7 to the S&P contributed 15.36% return. The S&P was up 15.13, so it contributed just a hair over 100% of the return. Now, certainly there were other companies that were up, as there were other companies that were down, but those 7 really drove the performance. So once again, in closing, there are 3 things that we think will happen. Recession, which will happen as a result of macro data continuing to weaken until we see it just drop through the floor, which is typically the case. Or data starts to improve and flatten out, which would indicate a soft landing, and we'd be a whole lot more comfortable upping our equity exposure. Or the market broadens out, maybe through rotation or through telegraphing better times ahead, in which case we increase our exposure to those areas that have lagged well behind, not chasing the Magnificent Seven, but positioning those areas that have yet to see that kind of growth and have just frankly better valuations. So that's where we are for the second quarter and the first half of the year. If you guys have any questions at all, please reach out, give us a call, or shoot us an email at kaydanwealth.com. As always, thank you. And if there's anything we can do for you, please let us know. Take care and enjoy the rest of your summer.